Before we start, just understand this is not a signal service. Everything you see here is for educational purposes only. Trading involves risk, and the goal here is not to follow trades, it's to learn the process behind them.
Good morning, and welcome to I'm the Trader Capital live trading for law. It is Wednesday, May 20th. All right, first and foremost, all glory to the Most High. Let's bow our heads for a quick prayer. Our Heavenly Father, we thank you for your grace and your mercy. We thank you for another opportunity to try again to learn and grow in these markets. Father, we ask that your will be done today as it is in heaven. Father, I ask that you give us the heart of a giver and make us a lover of our neighbor. Please let me not lead anyone that listens to me astray, but use me as a vessel to bring your children back onto you. In Jesus' mighty name we pray. Amen. Can the church say amen? Amen. Let's begin. Before we jump into the charts, I just want to say this. There was a time I used to sit down on the charts with no real plan, jumping between strategies, losing, blowing accounts, second guessing every entry, and honestly just hoping that the trade would work. And that's where most traders are today, not because they're not capable, but because they don't have a structured process. The biggest pitfalls that causes traders to fail is that they have no knowledge on money, they don't know how to lose, they don't know how the markets operate, and they don't have a winning model. 90% of traders fail, all 90% are plagued with one or more of these pitfalls. Today, I'm going to show you the 3 pillars that every trader must have in their trading to survive and thrive in the financial markets, so you can join the 10% who succeed and fast track your way to the top 1% of the wealthiest people on this planet. It's called the 10% to 1% club. Let's go. Woo! But before we dive deep into the 3 core pillars, when you step into this arena, on this battlefield, you must first have 2 crucial realizations. Realization number 1, trading is war. This is not a get rich quick scheme. This is the hardest thing that you'll ever do in your life. Realization number 2, all traders are money managers. As a trader, your ability to manage money is vital to your survival in this industry and in life as we know it. Most traders think that success in the markets comes from finding the perfect strategy or catching the biggest moves. But the reality is, trading success is built on 3 core pillars. First is money and mindset. This is the foundation of success. Then is risk management. This is the holy grail of trading. This is what will keep you in the game long after everybody else has quit. And lastly, we have trading edge. This is where all traders start. I know this because this is where I started. That's why in today's session, we're going to hone in on your trading edge. Now, everything that we do here is built around one thing, and that is confidence in your trading edge. And I am the Trader Capital. Our confidence comes from 3 things. First, it comes from understanding how the market actually operates. Not what social media says, but how money truly moves. Second is having one trader model. One model with IPDA signatures that we trust and execute on a consistent basis. Third is having a plan and a process, because without a plan and a process, you're just reacting to price and you're winging it each and every time. And this right here, this session, this is where we focus on the 3rd piece, the process. So many people lose confidence in trading and in life because they simply don't have a plan. There's no process they're following. There's no procedures and protocols that they're abiding by. They literally are just winging it. And they wonder why they can't get consistent. They wonder why there's ups and downs in their equity curves. They literally can't figure it out. The uncertainty of not knowing exactly what you're doing, how you're doing it, why and when you're doing it in the market will cause you to fail in trading. Confidence and certainty are key if you want to be successful in trading, and it's your responsibility as the trader, as the analyst, as the fund manager. It's your responsibility to attain that confidence, not only in your model, but also in your processes. So what I want to do right now real quickly is I want to share with you the process that we teach all our analysts at I'm the Trader Capital, and then we'll see that process live in action. This is the 3-step trading process. Step 1, condition. This is where we determine our bias. Before we even think about entering a trade, we need to know the market program. Are we in a buy program or sell program? This is where the market shows its hand. Then we have step 2, stage. This is what sets up your trade and what does your trade look like. There are 2 types of trades, retracement setups and continuation setup. Then we have step 3, execution. This is how you're going to enter, manage, and close the trade. At I'm the Trader Capital, we have 4 entry criteria before executing. I'm not here to force trades. I'm here to execute my plan step by step in real time. All right, let's get into the live trading flow. Now, as you're watching, don't just look for entries. Pay attention to the process behind the entries, because this is what will get you into the 10% of traders who succeed. And if you want to go further to the 1%, well, that's where we break down all 3 pillars inside of the program. I used to think that winning trades built confidence, but it's not the wins. It's knowing exactly what you're doing, when you're doing it, how you're doing it, and why you're doing it before, during, and after each trade. And that is what we're building here. Let's begin with our daily trading processes. Weekly target going to this week, all right, as always, is 3%. Mental check-in, feeling generally okay. All right, excited to see what price action has in store for us today. Excited to continue to grow, all right, and get 1% better. I got whooped by the markets yesterday, but today is a new day, okay? It's refreshed. I live to fight another day, so we keep it pushing and we keep following our procedures and protocols, right? Not letting the outcome affect us, okay? Acknowledge risk. I accept any risk that comes with trading today. I understand that trading comes with real risk and that losing is part of the battle. News. Like I said, it's Wednesday, May 20th, all right? We have high impact news coming out at 10:30. And we have FOMC this afternoon, one stage FOMC this afternoon. So it'll be interesting to see how price action is in the morning. If it's not too clean, all right, then cleaner price action will be in the PM session, okay? Either way, we have news today, making it an optimal day to take a trade. Risk going into today, we're at 0.25 of account size, and we have a max of 0.75 per account on the day, all right? Weekly program going to this week is a sell program. Let's go ahead and review price action overnight, okay, to see if anything's happened to change our weekly program here at I'm the Trader Capital. All right, all right. For our weekly program to flip, all right, from sales to buys, all right, we'll need to come up and take Monday's high, okay? Price will need to trade to and through Monday's high to flip our weekly bias. So far, all right, we're still in the sell program on the week until Monday's high is taken. Let's go ahead and adjust our high time frame dealing ranges. This is the low right here. Let's get previous day. Yesterday was just an unfortunate day. I went back in though. I went back into through the day and kind of picked up a few things that I'm excited to watch it go forward. Okay, I've kind of picked up a few things, but all the trades I took, I would take them again, right? But with more experience and more data collected, I'll be able to avoid days like that. Cause not that it was a bad. Yeah, it was a bad. It wasn't. It was a bad day. It was just whooping my ass. Just every trade that I took. Anyway, let me carry on. Every trade that I took was not every trade, the majority of the trades, but that's just how the cookie crumbles sometimes, right? Is we got a previous day. Okay. Still inside the range. So this is the high that needs to go for our weekly program to adjust. And until that high goes, okay, we're still in the sell program. Let's carry on with our processes. Next one is our 3-step trading process. I didn't want to talk about it, but I guess we can just see how yesterday ended. It was just wild. Okay, I'm back on this account. That's cool. Ended down $90 on this account, up 157 on the 50k account, and the other 100k account that was in profit. I lost like 6:05 on the day. Yeah. Anyway, when I went back, it was well, I took this trade. It was a loss. All right. Flipped to the other side, but I didn't get back in. Okay. But when I look back at it, it was still a macro setup. So it was a valid trade, right? And it gave us negative 1.5. We did have a 30 setup here that I didn't engage in, okay? Then I took this setup, got taken out, okay? Once I got taken out, it did offer a negative 1 to the downside, okay? So when I went back and looked at the price action, okay, there was obviously things that I noticed that I could have avoided some of the losses that I took. So that's all I can do. All right. I probably just did it to myself. I should have just been done after this wonderful trade, this wonderful 1150 micro trade. But it is what it is, right? I accept the risk that comes with trading, and I understand that trading comes with real risk, and losing is part of the battle. All right, as long as I live to fight another day, and I don't, blow everything all in one day, just because I don't want to end the day on a drawdown. Nothing wrong with ending on a drawdown. But we should have stopped. While I was at my drawdown, right? But it's all good though. Anywho, we proceed. Today's a new day. We've talked about yesterday. It's done. We move on. So step one, condition. All right, determine bias. How we do that here for us. All right, it could be different for you, but your step one always has to be determine bias. Or you can use different ranges. Okay, depending on what kind of trader that you want to be. Right, for us we use daily ranges and session ranges. Okay, so from 12 a.m. to current price action. No, the low is low. The high is high. Just like that, we've got our daily range. We know liquidity above and below. Above we have previous day's high, which is also in line with that can't be. Hold on, give me a second. It's using the candle, right? Okay. We got previous day's high, apparently. And above that, we go Monday's AM session open range buy side. And then Monday's high, okay, which is also a dealer range high. Below or inside, we got London session sell side. And below we have Asia session sell side, lunch session sell side, previous week's low and previous day's low. And we're ready for kickoff. Ding, 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 ding. 9:30 kicking off. Open bell. Open range gap, all right, decent size. Is below price, okay, so we gapped up, so we have a premium gap up. Let's see what today has in store for us. What's today? Wednesday? Risk Management Wednesday. Risk Management Wednesday. Completely forgot. Nothing for us to do here. Risk Management Wednesday. Bear me. Still getting my bearings this morning. It's been really tough for me to wake up. Then again, I've been going to sleep like kind of late, not gonna lie. I'm still waking up. Before we dive deep into risk management though, let's take a brief moment, okay? And let's review our money exercises from what? From phase one. Sorry, I'm seeing something here. There's an old material. Seeing bad mistakes. Anyway, money exercises from money and mindset. What are your money goals and targets, all right, for earned and passive incomes? What are your money goals and targets for earned income and passive income? And your goal and target now, all right, obviously will be different a year from here, a year from now, because hopefully you would have hit a target, all right, which will allow you to increase the target and then allow you to increase the goal too. You know what I mean? But risk management, all right? It's all about protecting capital, managing risk, and ensuring longevity in trading, okay? This is what will keep you in the game, all right, long after everybody else has quit. This is the holy grail of trading. And in this session today, all right, we're going to go over why risk management is the holy grail of trading, all right? Or mistakes to avoid, all right, mistakes and what to avoid, all right, how to conquer fear of losing plus the limitless potential that, you know, trading offers us, and how to mitigate risk and flatline equity drawdown, okay? How do you stop yourself from having bursts in your equity drawdown and sharp drops in your equity drawdown, right? Flatline it. That's what's on the agenda for risk management, okay? And that's what we'll be discussing today. Nothing for us to do here right now though, okay? Still waiting for one side of the dealing range to get taken. Either that or post 10 o'clock, or we get open range, dealing range, and we'll see if that will give us some action. But taking my sweet time today, all right, after being burnt yesterday, after getting whooped by M&Q yesterday. I am not in a rush, all right, to jump into anything right now. Okay, I'm waiting for 950 macro. All right, I'm gonna trade all macros the remainder of this week and see how I feel. Okay, anything in the 30s, we'll just have to tape read them and keep it pushing from there. Anyway, my mentor ICT, all right, Michael J. Hudson, once said this about risk management, and I'm quoting, okay, in quotation. This is more important than my entry and exit signals. This is the absolute key and cornerstone to long-term success in trading. All right, and this he was talking about risk management. It's just further reinforcing the importance, the emphasis of risk management in trading. Okay, remember the second crucial realization, all right, when you step into this battle, all right, in this arena, is that all traders are money managers, all right, and your ability to manage money, right, manage money in terms of risk, all right, is vital to your survival in this industry, okay? And Michael just emphasizes that here. All right, now Alice, why do you think risk management is the holy grail of trading? Why should we take your word for it? You know what I'm saying? Right? When you step into the trading arena, right, on this battlefield, you're competing against central banks, institutions, and professional traders, entities that are not in the business of losing money. You're competing against giants, the giants of this world. All right, like I keep saying. All right, in trading, risk management is your edge. It is your shield. All right, your only defense against the central banks. The only aspect of this game that you have control over is risk management, okay? Your risk management is your shield, right? Let's say your model is your weapon, right? Your model is your weapon and your risk management is the shield, right? And you need both, right? To protect yourself, all right, and to be able to be on the offensive, right? Because you don't want to be on the defensive the whole time you're in the market, right? Because if you play defense, more opportunity to get scored on, right? Right? So you want to defend and you want to be able to attack, right? When the enemy shows a bit of a weakness or a gap, you want to be able to attack, all right? You cannot control the market, but you can control how much you risk on each trade. Like I said, this is the only part of the game that the trader, the analyst, the fund manager has control over, all right? Everything else you cannot control. But risk management is the one thing that you can control, all right? That's why it's your shield. And you must know the mistakes to avoid. You must know the mistakes people make in risk management and then be able to avoid them, okay? And that's what we'll talk about in the next slide, all right? But just understand, risk management is the holy grail of trading, all right? Because it's your shield and the only thing that you control on this battlefield. Remember, central banks didn't make these markets for you to win, all right? They didn't make it for you to win. It's a zero-sum game, right? For them to win, Somebody has to be on the other side losing. All right, understand that. Okay, so how should you view risk, right? Let's get a better understanding of what risk is. Okay, risk is the potential for loss and a necessary part of trading. Okay, like I've said before on this sessions, that risk is part of life, right? You cannot avoid risk. That risk comes with just being alive and breathing on this planet. There's risk in everything. Okay, there's risk going to your 9 to 5, like I've said before, right? There's risk waking up and going to shower and just slipping and falling, right? There's risk in everything that you do. All right, so just understand that it's not just in trading, it's in life in general. Okay, and being able to manage risk, right? You're not always going to be able to manage all the risk, right? But there's some risk that you can manage. Okay, let's say you're late to go to your 9 to 5, you're on the highway speeding and just trying to cut people off. Whose fault is that? It's you, right? The only thing you can control is you, right? And what you're risking, right? So wake up early, drive slow, right? Make sure you're doing your part, because you're the only thing that you can control. You can't control what other people do on the road, right? Anyway, yeah, risk is a necessary part of trading. Okay, you have to control the amount of your risk in your account. All right, it's imperative that you do this. You have to control the amount of risk in your account. If you don't do this, right, no one is doing it for you. All right, no one's gonna do it for you. Your broker ain't gonna do it for you. All right, your model ain't gonna do it for you. Right, these charts won't do it for you. Your trading groups won't do it for you. It's you. All right, you have to be able to control the amount of risk in your account. If you do not do this, all right, you will certainly lose. All right, in this game, you will lose on this battlefield. All right. So how should you be looking at risk, and how can you manage risk to survive and have longevity in trading? You need to understand that there are only two things promised to traders. I talk about this all the time. Every time I take a loss, I talk about this. All right, there are only two things promised to traders. All right, and that is: one, every trader will encounter a losing trade; two, every trader will experience a series of losing trades. These are the only two things promised to you. All right, we've taken dealing range high. All right, also smashing previous day's high, confirming our daily program as a buy program, which is going against our weekly program. Okay, so let's be aware of that. All right, so right now we've got step 1, all right, condition. All right, we're in a buy program. Now we're waiting for step 2 stage. All right, we can either take two types of trades, right? A retracement setup or continuation setup, depending on time and price. All right, will let us know, hey, this is potentially going to be a continuation setup or retracement setup back inside the range. So now that we've got step 2, we wait patiently. Now that we got step 1, sorry, we wait patiently for step 2. All right. So coming in off the bat, right, we know that the only two things promised to us, that every trader will encounter a losing trade and every trader will experience a series of losing trades. Okay, no, you're not special. You will experience a losing trade. You will experience a series of losing trade, no matter if your model is 90%. There's nothing, that 100% isn't guaranteed here. All right, you never get 100%. Even if your model is 90%, you're gonna lose, right? You're gonna experience a losing trades. It's our job to mentally prepare for those losses, all right, and manage them accordingly. Now that you know and understand losing is the one thing promised to traders, you need to have a plan and procedures in place to weather losing trades. Okay, this is why in the trading edge aspect we came up with a risk management plan as well. Okay, but this is just going to go further deeper into risk. I don't have time yet. Okay, so nothing for me to do right now. We're waiting for a 950 macro to kick off, see what it's saying. I'm becoming a macro slowly. The market is pushing me, all right, to becoming a macro trader. So let's see how it goes, innit? Let's see how it goes. Ain't even my model too is like, ooh, just not that yesterday there were losses in the macro too, right? It's not at end or be all, right? It just increases the probability of setups, but you're still gonna take losses, right? That's the only thing promised to us. It's only guarantees here. That is the only guarantee. You know how they say the only thing promised in life is death and taxes? Well, in trading, the only things promised to you is a losing trade and a series of losing trades, okay? So planning for losses is key to survival, all right? So now that we know that, that's the only thing promised to us, we have to have a plan in place for the losses, right? And that is our key. A well-structured risk management plan prepares you for inevitable losses and protects capital, right? You're going to have losses. You're going to have losses. Control them, and over time, you're going to make more money than you lose, all right? That is risk management in a nutshell. Oh, what did I do there? We've got time on supporting time frame. We've got time on supporting time frame. We're waiting for the 1 minute to close, all right? We're gonna go over common mistakes, all right, and what to avoid in risk management, okay? Okay, so we have time now. What is price doing? All right, we're taking a short-term low below external liquidity. All right, would have to come up here, take this buy side for me to be interested in a continuation buy. But for now, still nothing for me to do. We're waiting to see what type of trade we'll get here. I'm just seeing if it will allow me any contract size, because it's quite a big range, not gonna lie. Okay, one contract, Larry. That's only if this is the low though. Only if it doesn't go, if it goes any lower than this, it won't give me an opportunity. So for supporting time frame, this is the high that needs to go. All right. So I mean, feel what's it? Actually, nothing I can do here. All right, common mistakes and what to avoid in risk management, okay? Common mistake number one, over leveraging, all right? Risking too much on a single trade, all right? Don't try to rush profits. All right, this is something that I've fell victim to as well, okay? And even to this day, I still battle, all right, in terms of not trying to rush, right? I'm thinking, hey, I've spent enough time in the markets now. I should know what I'm doing, right? It's been over 6 years. I should know what the hell I'm doing, all right? I should be making big, huge profits by now, okay? But you can't rush. You can't rush it. You can't rush it, all right? You can't over leverage, and you can't try to rush to make a bunch of money in a single trade, all right? Take your time. It's bite size, right? We're going in. We're taking bite sized pieces out of this ocean, and nobody is none the wiser, all right? You can't be trying to risk too much, all right? Take a loss and then over leverage to make to go in like twice the contract size, right, to make what you lost plus then some, right? We've all been there, we've all done that, we know how that ends up, and it's never good for the account, okay? It's never good for our mental either, right? So avoid over leveraging, okay? Have a risk, like we talked about yesterday, the risk management plan, okay? Have a risk management plan that doesn't risk no more than 2% of your equity. Even starting out as an early trader, 2% is a bit too much, all right? I'll say at least stay at below 1% and below, okay, until you get seasoned, all right, in your model and what you're looking for in price. Then you can start increasing, by point, Common mistake number two, all right? No stop losses or take profits, all right? You're just getting a trade to get in a trade without a predefined exits, either in profits or a stop loss, right? Always have a stop loss, always have a predefined target and where you're aiming for price to go to, okay? Depend on what your trade management plan is, if you're going to be a full pool trader or you're going to be a partial trader, all right? You need to have predefined exits, all right? Always have a stop loss, always have a stop loss, always have a stop loss, all right? Because remember the three uncertainties, right? One, in the financial markets, black swan events can take place at any time. It doesn't come with a warning. Black swan events, all right, they don't come with a warning. Hey, tomorrow at 9:30 kickoff, okay, there's going to be a black swan event, so be prepared. You're not going to get that, unfortunately, all right? So you always have to have a stop. Even though your exits aren't guaranteed, right? It's best to still have them anyway in place, okay? All right, so always have a stop loss, right? And gap, if you're going to trade overnight, right? And second risk in trading, gap risk, right, in terms of new week open and new day open. So if you're going to trade overnight, all right, over the week, hold over the weekend, all right, like swing traders and position traders do, always have a stop loss, right? Because you never know, right, where the price is going to gap open, or you never know when a black swan event is going to hit. Okay, also the third one is technical issues. You're never going to know where you're going to have technical issues, right, with a broker, all right? So always have a stop loss, always be aware of that, okay? Have predefined exits. 3, revenge trading. Oh, now this, we can go on about this all freaking session. Hold on, it's about to be 10 o'clock. Revenge trading. I even to this day, I still get that feeling like, oh, I can't believe the market took that away from me. But I've worked hard to subdue my gambler. All right, so it's a work in progress. I have to wait for the 1 minute candle to close, but still get ready. me moon, I'm in feel what's it. So revenge trading, trying to win back losses with bigger trades, all right? Avoid chasing large profits like we talked about in the beginning, the first one, okay? Revenge trading happens when you take a loss and you're like, oh, you know, you try to win back that loss. So you go in with more contract size, right? To get back the money that you lost and then some, right? And we, like I said, we all know how that story ends. We don't need to be a genius. We don't have to have seen the movie here to know how that story ends. All right. That is not what you want to do. So these are things that common mistakes in risk management that you want to avoid. Avoid them at all costs. Okay. Because they will be detrimental to your account. So me moon I'm in feel what it. With the things you did do me what it. Oh yeah. Give you all, give you my world. So me moon I'm in feel what it. Alright. Risk management, common mistakes to avoid. Alright. Focusing only on winning trades and ignoring the importance of managing losses. Oh, what just happened there? Did it flip something? Focusing only on winning trades and ignoring the importance of managing losses, right? You cannot avoid the losses. You cannot just turn a blind eye when you take a loss. Oh, it don't really matter. Let's only focus on the trades that pan out, right? It's out of the losses, right? This is a huge tip here. It's out of the losses, right, that I've seen the majority of my growth spur, all right, from taking losses and analyzing the losses, right, analyzing the data, comparing it to the winning trades, and extracting, right, the characteristics that I want out of the price action, right? I'm seeing, hey, when this happens, 70% out of the time, I know I'm offside and the trade usually results in a loss. Okay, that's how you grow. That's how you get that 1% better every session. Okay, all right. So don't only focus on winning trades and try to turn a blind eye on the losing trades. It's out of the losses is where you grow, right? Out of the ashes you arise a new person. Let me shut up. Losses are what make you. They are what makes you, right? They also can break you. All right, next one is not adjusting not adjusting position size, keeping risk content. constant. Failing to reduce risk after a loss or a series of losses. Okay, now, why did I take a bite? I'm about to go into my explanation. I'm gonna finish it. Now, unless obviously you're at your lowest leverage size, which I currently am right now, right? I'm at my lowest leverage size, right? 0.25, and then I'm gonna go up to 0.5. Then after 0.5, I go to 0.75. Then we go to 1. And I'll stay at 1 for a little bit, all right? And then I'll eventually head all the way up to 2%. But right now, I'm not ready, all right? I'm not mentally ready. I'm not experience-wise ready to be at that those risk size. But the goal is to work my way up there, okay? So not adjusting position size, keeping risk constant. Let's say you take 2 losses in a row, right? Nothing wrong with keeping going in. You take 1 loss, all right, at let's say 0.5, all right, then you have a, this is why it comes to play, where you have to have a risk management plan, right? What is your risk per day? Like, how many trades are you willing to lose? How many percentage of your account size, equity are you willing to lose in the day, and then you're done, right? That's where this will come into, if whether you're going to reduce position or keep risk constant. But a lot of new traders, they come in, they're going in at, because the industry standard is 2%, all right? They come in, they start at that 2%, and they take a loss at 2%, and they'll go back in with that same 2%, keep taking losses at 2%. At that rate, right, the probability of you blowing out your account rapidly increases, right? Especially if you're not reducing your position size after taking a series of losing trades, okay? So my recommendation, right, is don't risk no more than 2%, right? If you're new, I say no more than 1%. To be honest, you want to be at 1% and below, all right, until you collect enough data, build enough experience, all right, under your belt, to then increase size in your trading, okay? But if you're on a series of losing trades, remember, the only two things promised to us is losses, all right, and a series of losses. So our job here is always to prepare for that loss, prepare for that series of losses, all right? And by reducing our position size when we take a loss, let's say we take a 2% loss initially, right? We go down to 1%, right? We're reducing that probability of that next trade being a loss, and then taking another 2% loss in the day, right? At that point, we'll be at 3 after 2 and 1. 3 instead of 4, right? So it's something that, you know, you have to experience for yourself, right? Whether you're going to be one loss, adjust position size, or a 2 loss, adjust position size, all right, or 3 loss, then adjust position size, right? But I wouldn't go no more than 2 losses and then adjust position size, all right? Because you're already taking 2 losses out a single position size, all right? What are the chances that the next trade is going to be a loss, right? You probably are starting your series of losing trades, right? You never know when the series of losing trades are starting. So you have to be prepared for it. That's our main job. You have to prepare for that series of losing trades. And you do that, all right, by reducing position size after taking losses, okay? Even after taking multiple wins, right? Even after taking multiple wins, prepare for that losing trade, prepare for the series of losing trades that are to come, right? Don't think you're on a high and you can keep going and you increase your leverage, all right, in every trade because you've been winning and you're going to continue winning. No, all right? The loss is coming, all right? We need to be aware of that. We need to prepare for that. It's like the boogeyman. That's the one boogeyman that we know is out there, all right? It's trying to get us, all right? So we need to be prepared for that boogeyman. We need to have our shield ready to go. Oh, let me set an alert here. So me moon and feel it watch it. With the things she they do, me watch it. Ah, yeah. Give you all, give you my world. Avoid short term into long term. All right. What this means is holding losing winning trades for too long, hoping that the market will turn. So let's say you get into a trade. All right. Your trade management plan said you're entering here and you're getting out here, but you see that, oh, the market, you in your head think, oh, the market could potentially keep going, so you keep adjusting, right? You turn your short-term trade into a long-term trade. You keep adjusting your take profit, thinking that the market is going to give you more than you're owed. All right, that's what that simply means. All right, avoid short-term into long-term. All right, holding losing trades, holding winning trades. Right, even in the losing trades, right, you keep adjusting the stop because you think, no, the market is going to turn. It has to turn. It's going to turn here. So I don't want to get out with a losing position. All right, avoid doing that. Avoid doing that. Once you enter the market, it's out of your hands. All right, you need to have a point of invalidation where your trade is invalidated, your trade idea is invalidated, so the market is taking you out and is doing the stop loss is doing its job. All right, because once it hits this invalidation point, you know that you're offside and potentially the market could be going the other way. Okay, you also need to have a predefined target that hey, this is my idea and I think price is going to head to this target. Have a predefined target, right? Whether you're going to be a full pool trader or a partial trader, have a predefined target. That was the second point that we talked about. Okay, all right, don't try to ask more out of I've done this before and I've been burnt so many times. Even recently I've did this, trying to ask a bit more out of my trade management, a bit more out of the market, and it ended up backfiring on me. Okay, so just stick to your plan that you set for yourself. Okay, it's going to be hard every day trying to be disciplined enough to follow your plan, but that's our job here, right? This is the only thing that we have control over, and it's hard to control ourselves sometimes, but you have to be able to control yourself. Trust me, I fight this battle each and every day, each and every session. I'm in here with you, man. I'm in here with you. I understand the struggles. I get it, right? I'm saying all of this, but these are common mistakes that I sometimes generally, make. They're mistakes I make as well, right? Even at my current level right now. Not that I'm at any level or anything, but I'm just saying after 6 years of being in here, I'm still making some of these mistakes. It's tough, all right? It's a fight each and every day, man. It's a fight each and every day, but the goal here is just to be 1% better. It's okay to make mistakes. We're human, all right? As long as we're in this flesh, we're going to sin and we're going to make mistakes, all right? It's just about learning from those mistakes and repenting after you sin. Taking open range sell side, all right? So the session bias has been confirmed as a sell program, which is going against our daily bias, all right, but it's in line with our weekly program, all right? Be aware of that. So be you want to you make me a common. Anything you want, anything you want. See my baby, yeah, yeah. I could give you all my love. Fight for you like say it be war. Make it be your command. Come make it be your. All right, next we have don't assume that taking small risk defined trades will not grow your account. All right, don't assume that taking small defined trades will not grow your account. All right, it's a misnomer that new traders think that you have to win big, right? Each and every trade has to be a big win. It has to be a winner. Yeah, it has to be the biggest win of all times, right? But that's not the case here, right? That's a quick way to ensure that you fail and you blow your account. All right, taking small predefined risk. Think about compound interest, right? You're taking small predefined risk, all right, that once compounded over time, right, builds the account slowly but surely. All right. We don't want to get rich quick. We want to get rich the for sure way, and that's with managing our risk. So me moon I'm in feel what that's a V-shaped setup if you ever seen one, right? So I'm watching it as a retracement, okay, to take buy side here. But if we end up taking sell side down here, I'll also be interested here. Like V-shape entry. I haven't been taking V-shape entries, you know, probably because I haven't been seeing them like clean like this. This is clean. This is super duper clean. Okay, giving us bread and butter there. Let's see how many contracts it would have allowed us. One contract, Larry, targeting -1, which wouldn't have taken us out yet. All right there, -1, cool. That's a V-shaped entry, boy. That's solid. That's nice. Gave you multiple opportunities on support and time frame to get back in, to get in. Cool. That was nice. Nothing for me to do though. Now we're watching to see what else this trade would offer us, okay? Come mega be yo. Commando. Anything you want, nigga. Alright, next is risk and capital you cannot afford to lose. Risk and capital you cannot afford to lose. Alright, is being a desperate trader is not cute at all, nor is it healthy for your account, okay? This is not the casino, this is not gambling, okay? Don't come in here with money, with your rent money for next week and thinking that you can flip it in a week. That's not how it works. I'm telling you now, you'll end up losing your rent money. Never put money at risk that you cannot afford to lose, okay? Then you're gambling, and your state of mind is desperation and gambling. The gambler comes out even more, right? That's when you fall victim to all these mistakes that we talked about. When you come in risking capital that you cannot afford to lose, because obviously I know life is hard, right? You need to pay rent, you need to make money, you need to buy food, but you cannot come in here with desperation, right? To make your ends meet, risking the small money that you have, all right? So don't risk capitals that you cannot afford to lose. And lastly, don't look for others to measure against, all right? Trading is a solo sport. Just because one other person is profitable and they were it took them 2 years to become profitable, and it's taking me 6 years to actually get to the consistency stage, right? Don't measure with somebody else, right? Because everybody's path is different, everybody's story is different, all right? Just enjoy your journey, enjoy your process, all right? And focus on you, right? Trading is a solo sport. What somebody else is doing has no bearing on what you're doing, right? Just because somebody else is making money doesn't mean that you're going to come in here and make money, right? But even if you're making money and somebody else isn't making money, don't compare. Like, oh, I'm better than them because I'm making money, they're not making money. Everybody is in a different phase of their journey, okay? So don't look for other people to measure against. Don't look for other people to validate your feelings, validate your model, validate your plan, validate what you're doing in these markets, okay? It's just you at the end of the day, okay? It's just you. It's a solo dolo sport, right? I'm used to a team sport. I play football, soccer. I'm used to a team sport, all right? But in here, it's just me. There's no teams here, right? It's just me. So these are the common mistakes in risk management, and obviously things that you need to avoid doing, all right? You need to be aware of the mistakes that majority of traders make, so you know what they are, and you can actually, when you know where the pitfalls are, right, you can step in a different direction so you can avoid that pitfall. All right, that's the whole point of knowing these common mistakes, so you can avoid doing them. Not saying that just because you know them mean that you're completely never gonna do them. You're gonna do these mistakes, right? But be aware that, hey, they are mistakes that you're making, and you need to correct that, right? Don't keep making that same mistakes. Once you're aware of the mistakes, right, then it's up to you. If you're going to keep repeating that mistake, then you're just making yourself insane, right? What's the definition of insanity? Doing the same thing over and over and expecting different results. If you're constantly making mistakes, what are you going to do? You're going to constantly blow accounts. You're constantly going to lose. You're going to think that trading is a scam. Is only for, the recruiting shit, and it's only for the rich. But it's not, okay? It's you doing it to yourself. It's about overcoming yourself, and that's the hardest thing to do, overcome yourself. Anyway, nothing for me to do here. We're watching this V-shape retracement setup here, okay? Using open range sell side, all right? It's obviously a continuation setup using the daily, using our daily program, because our program is in a buy program for the day, okay? So obviously we took buy side, price retrace into discount, okay? And now it's continuing in the direction of where we took, right? This is what we always anticipate, okay? So you see how the two ranges worked in tandem? It's just beautiful, right? You see how the two ranges worked in tandem to complete the price, right? It's beautiful. Like, we took buy side, all right? So we're anticipating higher prices, okay? Then price retrace into the range, all right? And we've got a continuation setup using open range sell side, all right? Which is in itself a retracement setup, but looking at the bigger picture on the day's program is a continuation setup. It's just beautiful, man. It's beautiful. It's nice to watch. It's nice to watch. Because obviously if we had got a continuation sell setup here, that would have meant that price obviously would want to dig deeper into the range, right? Targeting London session potentially, okay, which is inside of the range. But it didn't do that. It took open range sell side, completely shot up, right? V-shaped market structure shift, right? Because we would have required a short-term low taking below external liquidity and then a market structure shift. But when you get a V-shape like this, it's just obvious. It's playing that price. Hey, yeah, I'm not trying to do all that dilly-dally down here. I'm going straight up. So now that we know the common mistakes and what to avoid when it comes to risk management, how do we go into the market, right? Not fearing losing, since it's the only thing promised to us. How do we go in not fearing losing? Because taking a loss sucks. Losing sucks. Who likes to be a loser? Nobody. Nobody likes to take a loss. Nobody likes to lose. Right? I'm sure there's people in there that don't mind losing, but I'm not one of those people. I don't like to lose, right? And the fact that it's the only thing promised to me here, it just makes this game even much more harder for competitive individuals, right, that don't like to lose. Right? You just have to submit and subdue yourself, okay? Anyway, how do we go into the markets not fearing taking a loss, all right? Since it's the only guarantee here. This is how to conquer the fear of losing plus the limitless potential that trading offers us. That can overcome the fear, right? The potential, focusing on the potential, right, will allow you to overcome the fear. Fear and greed is what drives these market. Fear and greed is what drives this market. It's our number one job to overcome fear and greed. remember FOMC this afternoon, okay, so price action this morning might not be super duper clean. All right, I'm not seeing anything that's, this probably would be the only one. Okay, I'll be waiting for 1050 macro if I'm gonna do anything. Okay, so me moon I'm feel what it. All right, we're going to talk about the importance of risk to reward ratios in trading and how it helps conquer fear of losing. All right, not that I am a particular big fan of risk to reward ratio. I don't really like pay attention to risk to reward ratio. Okay, I mean, I do pay attention to it, but it's not like, it's not the end or be all for me. All right, I don't mind taking a trade that's a negative risk to reward ratio, just because I've collected enough data on my model to understand that it wins more time than it loses. So I don't mind negative risk to rewards. Okay, because sometimes here, like if I was to get into this trade with one contract that allowed me to get in, right, I'll be getting out here a -1, and this is a under a 1-to-1 risk to reward ratio. Hold on, let's, will be 350. Yeah, will be just about under a 1-to-1 risk to reward ratio. Okay, and either way, right, I was still making money, right? 1-to-1, 1-to-2, 1-to-3, -1, -2. Right, it's just about the outcome, not the outcome of the trade, but okay, it's about the model's probability. Okay, and that's why you have to back test it first. Bear me. Oh. Anything you want. In trading, fear of losing often arises from uncertainty about how much money could be lost on any given trade. This is why you have to have predefined risk. Okay, so you already, every trade that I get in, I already know how much I'm risking, how much I'm going to lose if you know it goes against me, and I've accepted that is a risk that I'm okay with. I've taken it and felt okay within myself. All right, be like, okay, I can eat these L's, so I can keep this risk. All right, so the fear arises when you don't know how much you're losing per trade, right? You don't know how much potentially, because you're going in with leverage and you haven't have a predefined risk management plan set in place, okay? And you're going in all just happy-go-lucky, like all trades are going to be winning trades, right? Not knowing that the only two things promised to you is a loss and a series of losses, right? We come in happy-go-lucky initially into this industry thinking, oh yeah, we about to make banks in here. We about to be Wolf of Wall Street up in this bitch, okay? And that's not the reality of trading. That is not the reality. That's the fantasy, right? And it's a fun fantasy to have, but that is not the reality, okay? This, as you can see, this continuation set of V-shape was scrumdiddlyumptious. I saw it too late, right? I saw it too late. I'm like, yeah. I even said it as it was happening, that this is the V-shape you've ever seen, a V-shape entry. Yeah, buddy. All right, cool. First hour of trading is behind us, all right? First hour of trading is behind us. We're targeting this buy side above us in price. I forgot where it's from or what kind of buy side it was, but it's not important. Buy side liquidity above price right now. That's our drawn liquidity right now. This was a nice setup, right? It also involves the macro swing, short-term high. So valid setup here. Just something I haven't seen in a while, okay? And at least it was fun to watch and collect the data on those anyway. Okay. This is where risk to reward ratios come into play, okay? Offering a systematic approach to managing risk and removing emotional fear, right? So if you have a risk to reward, let's say you're risking $100 and you have a model that can offer you a 1 to 2, you know you're risking 100 to make 200. So if you take a loss, you know it's going to be $100. There's no uncertainty in not knowing how much you're losing because you already said that. It's predefined already. You already know, hey, I'm going in risking $100. All right, if I lose, I'm losing $100. However, if I win, I'm going for a 1 to 2 in terms of what I'm risking to my reward, right? I'm getting $200, right? The risk reward ratio is a powerful tool that helps traders maintain profitability even with a low win rate while reducing the emotional toll of losses, okay? So it takes it out of your hands, all right, and it puts it into the tool's hands. Like you already know, hey, I'm risking 100 to make 200, right? If I lose, I'm losing 100, and I can go back in again, all right? Depending on what my risk defined is for the day, all right? How much I'm willing to lose for the day, for the week, all right? You always have those in place, right? That's how you control yourself, all right? That's how you manage losses, and that's how you manage risk in trading. So negative 1.5 on that continuation, but also retracement setup, okay? See how they work together there. Anyway, we took open range sell side, all right? And then we got a retracement setup which turned reversal, okay? Once we talked about this on Trading Edge Tuesday, which was yesterday, all right? Once one side of the dealing range is taken, it doesn't matter which dealing range, the market can only do two things. It can retrace to continue in the direction that it took, which it just did right here today. Or we just had both of them in two different ranges, which is sick. Or it can retrace, all right, to reverse and take the other side. So based on open range, dealing range, right, we took sell side and then we retraced to reverse in terms of going higher and taking open range buy side, okay, flipping our session bias, all right, to a buy program in line with our daily bias, which is going against our weekly bias, okay? So now we have two sessions in line, all right, but still they're going against our weekly bias. So just to be aware of where you are in the day, in the session, in the week, okay? And what program that IPTA is following, all right? Within the day, within the session, within that week. We didn't have a continuation set up here. Took sell side below it. Market structure shift back above it. That's a continuation setup. But obviously time time and price. It's not my setup, okay, but it's them. It's a setup. So Alice, what is risk to reward ratio? What is that? I don't even know what that is. I'm new to this. I'm new to this game. What the hell is a risk to reward ratio? All right. The risk to reward ratio represents the potential reward a trader stands to gain for every unit of risk they are willing to take. All right. For example, a 1 to 3 risk to reward ratio means that you risk $1 for the potential to make $3 gain. A 1 to 2 risk reward ratio means you risk $1 for a potential to make a $2 gain. Okay. So depending on risk to reward ratio is how much you're risking compared to what you're willing to, what the potential to gain in the market. Okay. How the ratio works, right? It's a predefined levels, all right? Before entering the trade, a trader determines the amount of capital they're willing to risk, all right? Stop loss level, all right? How much you're willing to risk. For me, is auto calculated with my position tool. Okay, so depending on where my entry is and where my stop loss is, stop loss will be for long will be here. Depending on where my entry is and where my stop loss is, as you can see, the quantity here, as I'm pulling it down, is decreasing, all right? Meaning it's just, this is allowing me one contract still, and now we have no contracts because it's a point zero. It always has to be a whole number, right? You can only enter the market with whole numbers, right? Depending on where the stop loss is, right, will determine how many contracts that I get in. So if my stop loss is here, it allows me 5 contracts to get in the trade. Okay, with the predetermined risk already, meaning I'll be losing 250 0.225% of a 100k account, right? I'll be losing 250 every trade. I already have a predetermined risk, okay, that's calculated for me. Okay, so if it's here and I go in at 3 contracts and I get taken out, I'm losing 250. It doesn't matter how many contract size I use. If it's the one and the stop is here, if it takes me out, I'm losing 250. Okay, so it's predefined, right? So the amount of capital they're willing to risk, okay, the potential profit target, take profit level. Obviously you have to have these predefined. For me, I use the fib, all right? It allows me to take partials, depending on how many contract size I get into a trade, all right? I'll partial and adjust my stuff based on the fib of the range here, all right, where the market structure shift, the leg of that market structure shift. With the swing high that causes that is used as a market structure shift, I should say. Don't know how to say that to make it make sense, but it makes sense to me. And lastly, if you risk 100 on a trade and target 300 reward, you have a 1 to 3 risk to reward ratio. Okay, like for me, it's not a really big factor in my trading, but I do recommend it as a a training wheel, right? When you're a newbie, right, in this industry, I do recommend using risk to reward ratio as a training wheel. So right, once you gain more experience, it's not necessary, you don't need it, all right? But if that's your model and that's how you want to manage your trade, there's also nothing wrong with keeping that. Okay, I think training wheel is a wrong thing for me to say, actually, so I take it back. Because training wheel meaning implies that if you don't take it off, you're still trading, but that, if it works for you, it works for me. For me, I tried it, okay? Initially coming in, it's what allowed me to overcome the fear of losing, okay? But once I understood, that these are the only two things promised to me, it didn't become such a parent in my risk management, okay? It's not a tool that I use to determine, hey, if this trade doesn't offer me a 1 to 2, okay, then I'm not taking it, or it's not. Because sometimes, yeah, it's a personal preference for me initially, okay, but it is a very helpful tool to help you overcome the fear of losing, because it's already predefined, right? But I already have my predefined risk and things. So in terms of risk to reward, it's not a big factor for me in my trading, okay? But it's personal, it's solo sport here, okay? What may work for me may not work for you, okay? You have to find out what works for you. It's just a personal preference, okay? So why risk to reward ratio matters, okay? One is profitability with a low win rate. Even with a low win rate, a strong risk to reward like a 1 to 3 can still yield profits. With a 1 to 3 RR, you only need a 25% win rate to be profitable, right? Meaning you can be wrong 75% of the time and still make money. Hear that? Let me repeat that. With a 1 to 3 risk to reward, meaning you're risking $100, all right, to make $300. It could be you're risking $200 to make $600, all right, a 1 to 3, all right, or you're risking $300 to make $900. Quick math. I'm testing my mental math right now. Let me stop. So it doesn't matter, right? It doesn't matter the numbers. It's a 1 to 3. With a 1 to 3 risk to reward, you only need to be right 25% of the time to be profitable, meaning you can be wrong 75% of the time. And as long as you have a 1 to 3 risk to reward ratio, you will still be profitable. Let that sink in. So when people are looking for like a 70% win rate, 80% win rate, 90% win rate, it's unnecessary, right? It's unnecessary. You just need 25% win rate with a 1 to 3 risk to reward ratio, right? And the numbers are always going to be in your favor, all right? Obviously, bearing that your model is profitable and get in being able to reach that 1 to 3, right? Your model has to be able to put the work in to get that 1 to 3. You get what I'm saying? But 25% of win rate, right? To then still be profitable, right? Losing 75% of the time, right? Losing 75% of the time, but with a 1 to 3, you're still profitable. Second, controlled losses reduces fear, all right? By setting a predefined risk per trade, okay, i.e. 1 to 2% of capital. I wouldn't recommend 2% if you're new to trading, okay? I'll say stay on 1% and stay under 1%, okay? 1 or under 1%. Traders know their maximum loss, removing uncertainty and fear, okay? So if you know how you're going in with a predefined risk and reward, right? There's no uncertainty that, hey, I don't know how much I'm going to lose in the trade, because you already know. You set that number, all right? And it's a number that you've taken, you've been in the market, you've demoed that risk and taken that amount of loss and been like, okay, if this was real money, how would I feel about this loss? Would it be something I can take, I can manage, all right? Because you might think that you're ready for a 2% loss until you take a 2% risk loss, and you're like, oh shit, I might need to go down, right? You might feel differently, okay? So you have to demo, get a feel for your risk tolerance, right? Try 2% and see how you feel. Try 1%, see how you feel. Try 1.5, try 0.5, try 0.25 and see how you feel, okay? How you react to it. And then be like, okay, this is a risk that I can tolerate, that I can probably take 2 trades and still be okay for the day, right? And still have another opportunity to potentially get in again, right? Okay, 3, all right, why, we're talking about why risk to reward ratio matters, okay? Focus on probabilities, not outcome, all right? We're process orientated here, all right, and probability orientated. We're not focused on the outcome. The outcome is out of our hands, right? We don't control that part. The only parts that we control is our main focus here, okay? And that is our risk and our processes, all right, and what we're doing in these charts. So me moon I'm feel what's it. All right. So trading with a favorable RR shifts the mindset to thinking in probabilities, not individual trade results. Okay. Maintaining a favorable risk to reward ratio gives traders a mathematical edge over time. All right. The numbers are on your side. This is your house edge in this casino. All right. I'm the house edge trader. This is our house edge. Okay. I'm the house edge trader. That's what the stands for. The house edge trader. The house edge. All right. That's why the house always wins, because the house has an edge. This is our edge that we've been going over, right, for the past couple of days in these sessions. This is our edge in the market. Our house edge in the market. We are the house edge traders. Okay. All right. Even with losses, the winners, all right, compensate for them, ensuring long-term profitability, all right? With the 1 to 3, like we talked about, you only need to be right 25% of the time, okay? I might actually do a study this weekend to see if my trades give me 1 to 3, you know? I might do a study this weekend. So 1 to 3 would be sometimes, right, and this is my queries with risk to reward ratios. Sometimes you could potentially be asking, oh, whoa, 1 to 3 is in line perfectly with -3. That's sick. Let's see if that hits though. You could be asking too much of the market, right? Sometimes you could be asking too much. This is why I like to partial and I don't like full pool, right? But you can also do a risk to reward ratio with partials in it, right? Partial at 1 to 1. Take something off depending if it gives you multiple contracts. But then obviously, if it's only one contract, it will only be a 1 to 1, right? Partial 1 to 1, 1 to 2, and then terminus at 1 to 3. But if you're doing full pool, 1 to 3, sometimes you could be asking too much of the market, right? Sometimes the market structure won't get to the point of what you're looking for in that price action, okay? And that's the one thing I don't like personally about risk to reward ratios. It's a helpful tool, 100% is a helpful tool, but sometimes it can hinder you in terms of what you're looking for. But as always, you can use risk to reward ratios and partial as it's hitting the 1 to 1, 1 to 2, 1 to 3, right? It can be the same thing I'm doing here. Instead of using the fibs, I can, if it gives me one contract, that's a 1 to 1 trade. If it gives me two contracts, I'll take one off at 1 to 1, targeting a 1 to 2 for the terminus, right? So that's how you can also adjust your risk to reward as well, okay? Obviously, you won't get the full pool aspect of trading, but you'll at least be paying the trader as it's hitting your ratios, okay? And lastly, confidence in risk management, all right? Why risk to reward ratios matters. They build confidence in risk management. A clear risk to reward ratio helps traders manage emotions, because if you already know how much you're going to lose in any certain trade, there's no uncertainty, all right, and there's no like emotions coming in, because I already know, hey, this is how much I'm losing if this trade comes and takes me out, okay? So it helps traders manage emotions, all right, knowing that losses are part of the process and can be overcome with proper risk control. This is the only part of the battlefield that we have control over. This is our shield on this battlefield, all right? We must control risk in the markets, all right? If you're not doing it, no one is doing it for you, all right? It's just you, okay? You're gonna have to do it. So me mood and feel what be the things where she do me what Also, so let's go over some win rates. The win rate and the risk to reward, the minimum risk to reward ratio needed to be profitable based on the win rate. So we already talked about 25% win rate. You only need a 1 to 3 risk to reward ratio. Right? If you have a 33% win rate, right, you only need a 1 to 2 risk to reward ratio. All right, this is the minimum ratio needed to be profitable, right? To be profitable, if you have a 40% win rate, all right, then you only need a 1 to 1.5 risk risk to reward ratio. If you have a 50% win rate, all right, then you just need a 1 to 1. All right, I could potentially just go with the 1 to 1 and still be profitable, you know. If you have a 60% win rate, okay, obviously it reduces the higher your win rate is. You only need a 1 to 0.7% win rate. And if you have a 75% win rate, you only need a 1 to 0.3 win rate, okay? So it doesn't always have to be a positive win rate, okay? You can also have negative win rates as well and still be profitable, ratio, depend on your win rate. Thinking in probabilities, not certainties. Risk to reward ratios are crucial to long-term success in trading, all right? It's helping to manage, let me stop bringing my own emotion, feelings into it. All right, it's always something hard to do. Helping to manage and minimize losses while maintaining profitability, okay? By focusing on risk management and setting favorable risk to reward ratios, traders can conquer the fear of losing, think in probabilities, and thrive even with lower win rates. All right, we got 1050 macro kicking off on our support and time frame. When you know your downside risk and have a clear plan for each trade, fear diminishes, allowing you to trade with confidence, all right? And that is why during Trading Edge, we talked about having a plan for risk management. Because once you have a plan, right, everything is not always going to go according to the plan, all right? But at least you have procedures and protocols to follow when something doesn't go according to your plan, right? That's the whole point of having a plan. We aren't expecting everything to go to plan, according to plan. That's why we have a plan and we have SOPs to back up that plan. Standard operating procedures, SOPs. It's things that you do, all right? It's standard, right? Operating procedures. If this happens, this is what we're going to do. If that happens, this is what we're going to do. Now let's talk about the limitless potential. The limitless potential here. Limitless, all right? Is how big you can think here, all right? That's where the potential is. Anyway, it's 50, 1050 macro. Let's see where we are. Price, we're above opening range buy side. We're above previous day's high. We're above dealing range high. So me moon, I'm in feel what's it. Oh, you guys will need to see this for it to make more sense for you guys. Here's a breakdown of how different win rates affect a trader's performance. Okay, we can still talk about it, we can discuss it. So we're gonna go over a breakdown of how different win rates, all right, affect the trader's performance, all right, and showcase the limitless potential that we have here. Okay, so we're gonna go based on an account size of a 10K account. Risk reward that we're going with is a 1 to 3, with a 2% risk per trade, meaning we're risking $200. Right, 2% of 10,000 is $200. We're risking $200 per trade, with a sample size of 10 trades per month. Okay, all right. Average profit is $600, and average loss is negative 200. Okay, so with a 10% win rate, all right, you'll be in the negative. With a 20% win rate, you'll be in negative. However, this is when you start making some money. Now if you have a 30% win rate, right, everything that we talked about, 10% account, 1 to 3, 2% risk, okay, with a 30% win rate, meaning you win three trades and you lose 7 trades. All right, total wins is $1,800. All right, total losses is $1,400. Your net profit is $400. Okay. Obviously, with a 40% win rate, you end up with a net profit of $1,200. 50% win rate, you end up with a net profit of $2,000. 60% win rate, winning 6 trades, losing 4 trades. All right, you end up with a net profit of $2,800. 70%, you end up with a net profit of $3,600. 80% win rate, you end up with $4,400. 90% win rate, you end up with $5,200. We're not even doing 100 because you're never gonna get 100% win rate. So that's scrap that. So you will need at least, with everything mentioned here, at least a 30% win rate, right, to be net profitable on the month. Anything below that, all right, you'll be negative. Okay, so just a 30% win rate, and you'll be net profitable on the month with 10 trades. All right, risking 2%, aiming for a 1 to 3. As you can see, okay, even with a low win rate, example of 30%, the trader still makes a profit of $400 because the 1 to 3 risk to reward ratio ensures that winners offset the losses. Okay, this shows the importance of a good risk to reward ratio in trading. Not that it's the end all be all right, but it's an important tool to have in your trading. Now that you know the common mistakes to avoid and that we shouldn't fear losing because the probabilities are on our side, all right, we have a mental I'm still sleeping. We have a mathematical edge, all right. This doesn't even make sense. Now that you know the common mistakes to avoid and that you shouldn't fear losing because we have the probability on our side, we have a mathematical edge, all right? How do you reduce risk and flatline equity drawdown? In this game, you have to be able to absorb losses, okay? And this is exactly how you do just that, right? We know that losses are the only thing promised to us, okay? So you have to be able to absorb the losses. What? You have to be able to absorb the losses that come, all right? And that comes with that risk management plan, or that we went over yesterday during our plan, the risk management plan, okay? It's the same thing here. Your procedures should ensure that no single trade or series of trades significantly impact your account, or capital preservation is our number one goal here, okay? So you need to have a risk management blueprint that we talked about yesterday, but we'll go over it again, all right? Risk no more than 2% of your equity if you're starting now. I say no more than 1% of your equity, okay? Have a model that offers a 1 to 3 RR at least, all right? Because then you only need a 25% win rate, all right, to be profitable, okay? That's why I mentioned a 1 to 3 RR, all right? It's not necessary, okay, but it's important if you want to have if you have a low win rate, all right, in terms of your model being a low win rate, you need to have at least a 1 to 3 RR. After a loss, all right, cut leverage in half, all right, depending if you want to do 1 loss or 2 losses, all right. But either way, after a series of losses, you need to reduce your leverage, okay, until, all right, maybe you've made maybe 50% of the loss, all right, or maybe 100% or 25% of the loss, or you just increase incrementally as you take wins, okay? It's up to you how you want to do this, right? This is where you put your own flair into things, right? These are just ideas for you to put your own flair into it, right? Bring your own personality into it, because that's when it becomes meaningful to you and it resonates with you, right? You can't just follow blindly. After 5 consecutive wins, all right, leverage is cut, right, to the lowest leverage unit, and then work back up to the highest unit. This is something that I'm going to be implementing once I start to increase my leverage, okay? Because right now I am at my lowest leverage, so there's no point for me to cut leverage or even increase it right now, okay? I know at the point where I can increase, okay? Once I start, being consistent and building more confidence, I'll obviously go up a leverage. But for now, I'm starting with humble beginnings, okay? Starting from the bottom, because I'm not trying to rush into profits, okay? That's a common mistake that people make. They try to rush the process. They try to rush the profits, okay? And that's a rushed way to blow accounts and not succeed in here, okay? And also have a maximum loss per day, maximum risk per day, per week, per month, okay? When you hit those metrics, you're done, right? You have to have limits. You have to set limitations for yourself, and that's how you control yourself. All right. That's how you mitigate risk and flatline your equity drawdown by reducing your leverage as you take losses. Okay, this means that you're not having wild swings in your equity curves. It's calculated. It's a calculated, predefined risk that you're taking. Okay, it means that you have that, the flat line in your EKG. I think, is that what they're called? You don't. Flat line means you with the Lord. Hopefully, if you were part of the church. But yeah, that's how you wanna flatline equity curve. You want it to go up incrementally, drop incrementally, go up incrementally. You don't want that zigzagging. That's just the heart palpitation. Like we're in trouble here. And if you want to obviously scale, I think tomorrow, Thursday, we'll talk about scaling. If you want to scale, right, in terms of how I want to scale with the hedge fund, then if you want to scale, right, for me, I want to scale with a hedge fund, okay? Obviously, investors, right, don't want to see that wild ass equity swings, right? They're not going to put money with you if your equity curve is like wild swing up, wild swing down, wild swing up. They want to steady, all right? They want to make sure that their money is protected, right? So they want a steady equity curve, all right? When you lose, you're taking a small loss, but when you win, it brings you back up, right? Your losses aren't. It's not a spiral down and it's not a spiral up, right? It doesn't invoke trust as a general partner, right? When we have wild swings in our equity curve. So that's why this is important to me, because that's how I want to scale, and I want to prove that you can do this with small defined risk. All right. If you don't want to scale, right, it's not a big deal, all right, but still you don't want swings in your equity curve. If you don't want to scale in the direction that I'm scaling, nothing wrong with that. All right, it's your choice. You do what you want to do. You still don't want wild swings in your equity curve. You still want to be able to flatline equity drawdown. As traders, okay, we're money managers. We talked about this, right? One of the two crucial realizations. As traders, we're money managers. These are the characteristics that every great money manager must embody. Okay, so these are traits of a great money manager. All right, the professional money manager understands that losses are cost of doing business. All right, they are the only thing promised. Taking a loss is just the cost of doing business, right? Like when you're going to a 9 to 5 and you buy gas, that's a cost of doing business, right? When you buy food, cost of doing business, right? Cost of going to work, cost of having a 9 to 5, all right? In business, when you buy material, is a cost of doing business, but obviously the goal is to sell the material more than you spend to buy it and make a profit, right? But those are cost of business. And in trading, taking a loss is a cost of doing business, all right? It's part of the battle, all right? It's part of this game. I don't want to say it's a game because it's not a game. It's part of this battle because this is war. All right, trading is war. It's part of this battle. I need to change that. Okay, great money. Traits of great money managers. They appreciate percentage over dollar gain and loss. All right, we're big on percentages. It's all about the percentage. Risk in terms of percentage, gain in terms of percentages. Okay, they appreciate percentage over money gain or loss. All right, it's about how much risk in terms of your equity in percentages that you're putting at risk, and where is the gain in terms of percentages that you're putting at risk. All right, so focus on percentages and not dollar amounts. All right, okay, learn to limit trade frequency. Oh, this is good. This is a good one because I need to remind myself of this one. I'm glad that we're talking about learn to limit trade frequency. I think yesterday I overdid it with myself, right? I I know for a fact I should have just been done trading after that 1150 macro setup. I should have just been, because that was the cleanest setup of the day, right? I should have just been done and just left everything as it was, right? Left everything as it was, right? Because then I was down $90 on one, up on 157, and the other one that ended up down 605 would have just been down about 240, I believe. Yeah. Even 240 or 190 something, right? It would have been just that instead of adding more to it, right? So learn to limit trade frequency. This is something that I also need to reinforce in myself, okay? Learn to limit trade frequency. Just because the setup forms, you know, as often as it doesn't mean I need to be in each and every one of them, okay? Just be content with enough, all right? When you make some money back, all right, and you're still down, be content with that and just learn to limit trade frequency, all right? Because the more times you're in the market, the more opportunities you're giving the market to take your money away from you, okay? All right, this is a big one, all right? This is something that I fell short on yesterday, okay? And I paid for it. Next, looking like there's going to be nothing for me to do here, all right? We'll be looking to see what 1150 macro has in store for us, okay, when we're done here. But in terms of, we'll need to come down, take this low for me to be interested. -2 get hit yet? No, hold on. 675. Yeah, no, it wouldn't have been hit yet. Wouldn't have given it to you. Let's see if this will even give us one contract, Larry. Yep. Yeah, we'll need to come down and take this low, all right, for me to be interested in a retracement setup. Right now, nothing for me to do, and that's okay. This was a setup. This was the morning trade, okay? And I would have been out a -1 already because it only allowed me one contract. So we're just watching to see what else it offers us, all right? We've got -1.5, waiting to see if -2 gets hit. And if that 1 to 3 up there gets hit today, okay? Keep the monthly return on the focus. Keep the monthly return on the focus. Don't focus on the day-to-day, all right? Don't focus on the week by week, all right? Be aware of where you are on the day. Be aware of where you are on the week, but keep the monthly return on the focus of your in the forefront of your mind, okay? That's why I always go over my weekly, because my weekly added together for the four weeks in the month to my monthly target, okay? So if I'm going for 3% a week, what that means, 3 times 4 is 12% for the month is my target, okay? Be content with enough. Be content with enough, all right? Be content with enough. I think moving forward, one thing I'm gonna implement is if I take a loss, right, and I take a next winning trade, that account is done for the day. It doesn't matter if it came out of drawdown or still in drawdown, right? If I take a win, that's already set in place. The account is done for the day. But if I take a loss, I'm allowed to go back in. If I take a second loss, I'm allowed to go back in one more time, all right? And that third loss, I'm done. However, if I take a loss and then I take a win, that account is also done, right? It doesn't matter, the outcome is done, right? That's done. That would have avoided, you know, a few losses that I took yesterday, okay? So be content with enough, all right? Even if that enough is ending in a drawdown. You can always go in more drawdown than you already are. So to just be content with that drawdown, all right? Be content with a 90% drawdown rather than a $600 drawdown, right? Actually, wasn't that. Be content with a 200, I think it was 200. Yeah, but 240 something or 250. Be content with a 250 drawdown, right? Rather than a $600 drawdown, right? I would prefer a 250 drawdown anytime over a $600 drawdown, right? So be content with enough, whether it's in wins or in losses. Be content. Be patient with drawdown recovery, all right? And that's one thing I'm noticing, that obviously I'm able to take trades and take winning trades and come out drawdown. So I don't know if it's getting to my head thinking, hey, I can come out drawdown in the same day. So that's why I keep going in to be like, you know what, I've done this, I've been seeing this setup. So, but just be patient with drawdown recovery, right? Don't try to rush to make your money back right in the same day, right in the same session, okay? Even right in the same week. Even if you end the week in drawdown, it's okay. There's nothing wrong with it. Be content with enough, right? And that goes both ways, in profits and in drawdown, right? Be patient with yourself when you're in drawdown, right? That's one thing promised to us. We're going to be in drawdown. That's as soon as you enter the trade, you're in drawdown, right? Because of spread and where the prices are, you're already in drawdown. We're fighting it already, okay? So be patient with yourself when you're in drawdown recovery. Don't try to rush to make profits, right? Remember, that was one of the first common mistakes that traders make, right? Think in probabilities, not in dollar signs, right? We're thinking if you're here and you want to make this a career, right? You're here for a long-term career. Don't let one session, one day, 1 week, 1 month, right, impact your whole career here that you're going to have in trading, okay? Think in probabilities, all right? As we went over with the risk reward, with the proper risk reward ratio, the probabilities are always in our favor, right? We have a mathematical edge on our side, right? So thinking in probabilities, not in dollar signs and how much you're losing or gaining, okay? Traits of great money managers is that they manage to keep risk below 3% max, below 3% max. All right, keep risk below 3% max. Like I said, if you're starting out new, I recommend staying at 1% and below, okay, until you gain some more experience under your belt, and then you can incrementally increase 0.25, 0.25, 0.25, 0.25, right? But don't go any higher than 3%. Keep risk below 3% max, okay? Don't go any higher than 3%. And lastly, they follow a money management plan. 11-11. All right, we're done here. We're about to wrap up here. We're almost done with risk management as well. They follow a money management plan and model, all right, that we talked about yesterday. That's a risk management plan. All right, traits of a great money manager is that they follow a money management plan and model. They're not just winging it each and every time. All right, they have a plan, procedures, and protocols in place that they're following. Okay, which eliminates fear and uncertainty. All right, risk management equals longevity. All right, this is the key to long-term success in trading. All right, the market is unpredictable, but your approach to risk can be methodical and controlled. Manage your losses, preserve capital, and you live to trade another day. All right, live to fight tomorrow. Live to fight tomorrow. Live to fight tomorrow, and the only way you can do that is with your shield, and that is risk management. Okay, risk management is not just a shield, it is the foundation for sustainable trading success. Okay, begin by implementing a solid risk management plan in your trades, right? Master risk and success will follow. This brings us to the end of phase 3, which is risk management. All right, make sure you have your risk management plan and model written down, and it must be referenced on a daily basis before and after a trade or a trading session. Okay, you need to be aware of your risk management plan before every trading session. That's why I always go over my risk for the day. All right, right now we're not adjusting it yet, okay, so it's staying at the same, but once we start adjusting risk, that's when it's imperative that you go over your risk management. That's why I always say risk going into today is 0.25 account size, and we have a max of 0.75. All right, I'm always aware of my risk going into my trading day, my trading session. Okay, so that's the end of the holy grail of trading. All right, tomorrow we'll talk a little bit about scale, and then it'll be scale and Q&A Thursday. Scale and Q&A Thursday. So to just show that we have something to talk about every time we're here. We're not just watching these candlesticks print, because sometimes it can be a boring endeavor watching these candlesticks print. So why not, go over some material and help ourselves and educate ourselves, right, in what we're doing here, right? So we can be better traders, better analysts, better fund managers. Okay. So that's the schedule. All right. Tomorrow is scale and Q&A Thursday, and then we're back to money and mindset Friday. But that's it for risk management today. All right. Let me know if you learned something. If you didn't, that's cool too. But I learned something. I went over a material that I haven't been over in a while. Okay, I'm gonna continue to go over it until everything is like in my head. All right, it's about reinforcing the information and hearing it over and over and over again, because you'll hear different things depending on where you are. All right, in life and in different season, you'll hear what you need to hear. So you have to surround yourself with the same message over and over and over again. All right. Anyway, let's do a trade performance review, because there's nothing for us to do here. We're seeing what else this trade will offer us. This was the only trade that I probably would have took today. Only one that had time and price. Okay. What I did well today is that I showed up, all right? I got 1% better, gained experience, learned lessons that I'll take into my next trading day, next trading session. All right, showed up today, followed my procedures and protocols. I didn't see anything in time that I would have engaged in, okay? So that's fine. I didn't engage in anything. -2 getting smashed. -2.5 getting smashed. And we're heading to that 1 to 3. We're heading to that 1 to 3. 1 to 3 was that -3. That was a clean continuation setup. All right, retracement turn reversal using open range session sell side. V shape if you ever seen one, right? I said it as it was happening. And we're taking that buy side. Oh, that was our draw on liquidity, okay? Yeah, you would be getting that. 1 to 3 right there. Just like that, 1 to 3. Hey, 1 to 3, Mr. Wall. Let's put it back. Hold on. Obviously, it would have to be a full pull 1 to 3, and you would have to just sit in this and right there 1 to 3. That's risking 250 to make 750. That's your week right there, right? That's your week right there. What are you talking about? What are you talking about? Solid setup there, solid setup. All right. Next time I will be in there. All right. The high was inside of the macro, solid. Came to it, boom, straight up, V shape. I need to, because I have these, all right, but V shape entries are also valid. It has to be clean though. It has to be a strong push. All right. No diddy daddling. All right. But where I fell short today, okay, will be wake up time and not getting my morning routine and completing my morning routine. Okay, it's been tough. Like I said, it's been tough for me because I've been going to bed late. But it's on me. It's on the traders, on the analysts. I need to do better. Okay, chart wise, I don't think I fell short anywhere. All right, I showed up. All right, didn't really take any trades. I missed the trade that I was supposed to take. All right, because it's not something that I've been really paying attention to. All right, collecting data, but I obviously caught it, just didn't engage in it. But that's fine. All right, it was good to watch it anyway, do his thing. Right, meaning that next time, obviously, if it gives me the opportunity, I will be engaging in those trades. So how I can improve for next trading session is keep showing up, right? Keep seeking excellence in everything that I do. Don't let short-term adversity, losses, series of losses deter me, distract me from what I got going on. All right, keep showing up, take into the model, procedures, and protocols, and don't deviate from it. Analyze the data. Yesterday, when I went back into yesterday's price action, I picked up a lot from it. Okay, all right. Obviously, in the weeds of it, I know what I'm looking for. But once you go back and look at price, in hindsight, all right, you pick up more things that you didn't notice while you were in the price action. Okay, so a lot that I picked up that I'm excited to walk forward, all right, and help improve my trading and get that 1% better. Like, it's usually when I take series of losses, that's when I know my next level up is on the way, right? Once I start taking losses, that I already know that the next level up is on the way. Okay, so, and I'm starting to see it already. So embrace the losses, all right? Embrace them. They're the only thing promised to us. Embrace them, learn from them, control them, and manage them. Okay, that's our job here. All right. Trade breakdown, let's do it quickly. All right, we took dealing range buy side, we established our daily program as a buy program. Okay, then open range session completed, we took open range sell side, right, confirming our session program as a sell program in line with our weekly but going against the daily. Okay, but then again we got a retracement setup turn reversal, all right, that confirmed the continuation setup on our daily using our daily dealing range program. Okay, so it was beautiful to watch how they just work together to create that continuation setup. Like, I'm kind of getting the picture here. Okay, it's just, It was lovely how the two ranges just coordinated that together, right? After you're beautiful, man. The things that you do is just incredible. And also, we got a continuation set up here, all right? But obviously, time and price, it wasn't my time, right? Key high external liquidity previous day, all right? We got, well, three here. We got open range buy side and dealing range buy side. We took liquidity below it, all right? Caused the market structure shift back above it. I noticed this yesterday as well. Hold on. When I went back into price action and I was looking at the day in terms of my setups and the potential setups that I saw, when the market structure shift happens on the 30, it's usually a valid setup. It's usually valid, right? Because the entry is in the 30, right? Even though the setup starts. Oh my god, did he put us on there? Even though the setup starts outside of a time I wouldn't really trade, it completes in a time that I would potentially trade, right? The 30s. And this would have been, another opportunity to get back in. Even in the 30s, we've got some setup here. Inside of the 30s, we come back below. Hold on. Take sell side, below external liquidity. And we've got a market structure shift back above here. Yeah. I'm gonna have that one account for the 30s, still. But yeah, anyway, this was a setup, and obviously we just broke down a few more setups, all right? We just broke down a few more setups. These would have been all valid entries inside of the 30 because I still take 30 trades. Okay, I have two accounts that are only for macro, and then I'll have this account that's in drawdown for 30s and macros. Okay, I'm going to take a 30 trade is going to be on this one particular account, this 100k one that's down. Cool. All right, solid day for me here. All right, solid day for me here. A calm one. All right, after such a crazy day for me in the markets yesterday. So I don't mind just sitting back and letting the market do its thing and just debriefing on the day, just collecting my thoughts and my processes and just collecting more data, right? Nothing wrong with that, okay? Any day at or above equity highs that you don't take any trade is a solid day in my books, really and truly. Beautiful price action today though for us here, all right? But that's it from us here. I'm the Trader Capital. Let's wrap this bitch up in a bowl. Let's wrap up. Before we wrap up, I want to leave you with this. There was a time that I would finish a trading session and still feel lost. Even on days I made money, I didn't really know why it worked. And on losing days, I had no system to fall back on. That's the difference between guessing and having a real edge. And here's the truth. Most traders only focus on entries, but consistency comes from the system behind the entry. So if you've been watching and thinking this makes sense, but I don't have the full system yet, that's exactly why I created the 10% to 1% club. That's where we go deeper into all three pillars, the full model, the risk management system, the money and mindset principles needed to join the 1% club, and the exact process to follow daily. If you're serious about becoming consistent, that is your next step. I used to think the goal was to win more trades, but the real goal is to become the type of trader who can perform no matter the outcome. Because once you have that, the results will follow. That's all for today, folks. Thank you for tuning in. I'll see you in the next AM session, kicking off at 9:15 a.m. Kickoff once again at 9:15 a.m. To be on time is to be late, okay? So make sure you show up early. As always, I'm the trader here, signing out. Good luck, good trading, happy bloody hunting. Remember, you only fail when you quit.